Good morning, and I see we actually have a gallery today. I'm delighted to see you all here today. My name is Alan Butendag. I'm a partner in our insurance consulting practice. I lead our consulting for Canada, focusing on life and property and casualty. I'm delighted to host you today at the first Insurance EyeOpener of 2013. We have a full house, so full that we've actually, as I mentioned, got some people up in the gallery. So thank you very much for making it out this morning. It's been cold and very chilly. Hopefully our discussion today will warm you up a little bit. So today we're going to be talking about navigating the regulatory matrix and the OSFI corporate governance. We'll spend a bit of time talking about OSFI updates to corporate governance, as well as some industry case studies on activities in the industry on this particular topic. We've got two speakers today. Rani Turna, who leads PwC's operational risk practice. She has over 20 years of consulting experience and advises clients on a broad spectrum of business issues, focused mainly in financial service and the insurance industry. She does a lot of work around operational risk, corporate governance, enterprise risk management, and internal controls. Rani's actively involved in the industry in a number of ongoing engagements. Joining Rani is Sandeep. Sandeep is a director in our financial services consulting practice. With over 12 years' experience, he too focuses on North American financial institutions and issues around corporate governance. He has a background in strategic risk management, risk oversight, enterprise risk management as well, and like Rani, is actively involved in the insurance sector and the financial services sector in Canada on a number of ongoing engagements. So with that, I'll pass it over to Rani to open up the discussion today. We'll try and keep it on time and leave a little bit of room at the end for some questions. And with that, I'll pass it over. Thank you.
Thank you, Alan. Good morning, everybody. And thank you so much for joining us this morning on what I think has turned out to be just the coldest day of the year. Today you're going to hear about OSFI's draft Corporate Governance Guideline, and we'll start by summarizing the key elements of the guideline, and then we'll talk a little bit about what we're seeing in the industry and how our clients are responding to the guideline. And then we thought it would be really interesting to give you some insights from our recently released 2012 Annual Corporate Directors Survey. And the reason we thought we would do this is because it'll give you a sense of what is top of mind for directors today. And as you think about what's top of mind for them, and you think about all the changes that are being proposed in the draft Corporate Governance Guideline together, that'll give you some great insights about how to move forward. We'll talk to you a little bit about what all of this means and how do the concepts come together. And then we'd like to talk to you about, one of the questions that I hear a lot is, so what's the scope of this? What do I need to do? Who would be involved? What would we be looking at? And through a case study, we'd like to take you through some of that. So let's jump right into it. In August, recently, OSFI have been quoted as saying that the current corporate governance guidelines are no longer consistent with the current industry practices and international standards. So as a result, on August 9th of last year, OSFI released its draft corporate governance guideline. And this was the first update to the guideline since 2003, which was released for comment, and I believe the comment period closed in September of last year. And we're all waiting for the final guideline to be issued. It has not been issued to date. So at a high level, the guideline was consistent with the 2003 guideline. However, it intensified the focus and expectations for effective governance in three areas. One, related to the board of directors. Two, around risk governance. And three, the audit committee. So although the comment period has closed, and OSFI are yet to issue the final guideline, I wanted to kind of give you a sense that many of our clients are engaging in discussions with us about what does this mean, what do we need to do, are there any short-term wins, can you come and talk to us about what we should be doing. And so just wanted to kind of say that institutions are moving forward with the requirements even though it is not final. Okay, so as I said, the 2012 guideline amplifies the responsibility and accountability expected of directors through mandating a higher degree of involvement in such things as management oversight, independence of board processes, and there's an increased focus on board committees and functions. In the guideline, OSFI have essentially clarified the essential responsibilities of the board and distinguishing between activities that are under the purview of management that should be reviewed by the board versus approved by the board. But what's important here is for the board to understand the decisions that are being made by management and how these decisions will impact the institution. It's important, the guideline talks about how it's important for the board to carry out its oversight responsibilities effectively, and as such, it needs to bring its collective experience, skills, and competencies to the table. That, is not new, and I think everybody would agree makes a lot of sense. But the guideline does set out a number of attributes that the board should exercise in carrying out its oversight responsibilities. I just want to talk about those very quickly. So the first is around judgment. Which ensures that well-informed decisions are being taken into account in the institution's business objectives and risk appetite. Secondly, initiative, exercising responsibilities in a proactive and timely manner to probe and to challenge what they're seeing. Responsiveness. The board should be responsible to raise issues, responsive to issues raised by senior management and other independent control functions or regulators, and that the board should oversee that these issues are being addressed and rectified. And operational excellence, it talks about that. And this is really getting at the practices that the board has to permit open dialogue and debate. What is new in the guideline is the requirement for an independent third-party review of board effectiveness. And really what they are looking for here is to be able to benchmark the company's practices against peers. In both versions of the guideline, OSFI took the position that demonstrable board independence is at the core of effective governance. And the degree of separation expected between the board and management, however, has intensified. And while we can all argue that there is not one standalone structure or process that will guarantee independence, but some things to consider that are set out in the guideline are boards should be independent from senior management and as such may carry out in-camera sessions. Boards may consider documenting and approving a director independence policy, and the role of the CEO and the board chair should be separated because they believe that it is critical to maintaining the board's independence and executing its mandate. So as we know, boards rely heavily on oversight functions such as internal audit, compliance, and risk management to help them fulfill their oversight responsibilities in a number of ways, including validating the effectiveness of the institution's internal control framework and the reliability of results. And a new requirement in the guideline is that the board may also commission third-party reviews to assess the effectiveness of these oversight functions. So the guideline does not stipulate how often these should be carried out, but what we are seeing in the industry is a move towards probably having these third-party reviews carried out every 3 to 5 years. That's just kind of what we're seeing. In terms of risk governance, I think it's fair to say that it's a very critical element of a corporate governance and really addresses how the institution identifies, assesses, and manages all the risks faced by the institution, including liquidity, credit, market, operational risks, and so on. And the most obvious change in the 2012 guideline is the increased focus on risk, which is not surprising given the continuing increased global emphasis on enterprise risk management. So in the 2003 guideline, OSFI recognized the importance of managing risk and of implementing policies to deal with risk exposure and risk tolerance, but it was less clear in the 2003 guideline who had the responsibility for enterprise risk management. Boards were expected to have a general understanding of risk exposures and techniques to measure and manage risks. So, as I said, the 2012 guideline is a major change from the 2003 guideline in terms of risk. Risk management is now a subset of risk governance, and FRFIs, financially regulated financial institutions, are now asked to develop a risk appetite framework that is both enterprise-wide and board-approved to help guide exposure, risk exposure in pursuit of business objectives. So it also says that the risk appetite framework should consider all risk types and should be forward-looking and consistent with the institution's business model and objectives. Another addition to the 2012 guideline is the requirement to establish a risk committee to be comprised of independent directors, and its mandate is to oversee risk management on an enterprise-wide level. And the risk committee is also expected to supervise and review the performance of the chief risk officer for the institution. And finally, as I said, the guideline does require the board to engage third-party reviews of risk management as well. I'll just spend a moment talking about the audit committee. So while the 2003 guideline did establish a broad mandate for the audit committee to become involved with audits, its authority was limited to discussing, reviewing, and meeting with auditors. But the 2012 guideline states that the audit committee, rather than management, should be responsible for approving external audit fees and the scope of audit engagements. The new guideline also codifies the role of the chief internal auditor within the institution, who should have a direct reporting line to the audit committee. So I think that these changes can be viewed as part of a broader trend of increasing the responsibility of independent board members and intensifying oversight on decisions formerly under the sole purview of senior management. So how is the industry responding? We're really seeing clients fall into three different categories. So the first is a wait-and-see approach, and simply put, that is, we're not going to do anything right now. Right, so there are some clients out there that are just waiting for the final guideline to be issued and are not taking much action towards addressing the guideline. Then we've got the cautious but progressive approach. So in the second, we're seeing that some steps are being taken by these institutions to move towards addressing the guidelines. So in this case, we do see our clients reaching out to consultants to understand what is the scope of what we would need to take, that we would be looking at, what are some of the steps that we might want to consider internally to start addressing some of these guidelines. And in the third bucket, we've got the proactive approach. So, there are some institutions that are just getting on with it. They are engaging third parties to carry out reviews of corporate governance, carry out reviews of the independent control functions, but it really just depends on where they're at with respect to their practices and whether they feel comfortable enough to move forward. They may have done things over the years in response to regulatory issues, and so, they just want to keep going. So I was dealing with one client that has decided actually two clients that have just decided, we're just going to get on with it. Let's just get all of these reviews done. We want to put it behind us. We want to show OSFI that we're being proactive in our approach. And to be honest with you, I think, as Sandeep and I were preparing for this and we take a look at the client, and we took a look at all the clients that we're working with, they mostly fall within bucket 2 and bucket 3. I think the key message is that there are very few clients out there that are not doing something. Okay. Oops. So as I said, we thought, when we think about the impact of the revised draft guidelines to our clients, we thought, again, it would be very interesting to leave you with a sense of the results coming out of our corporate director survey, because I think it's important, if you are the individual within your organization that is responsible for pulling this together, to get a sense of what is top of mind for our directors. And so with that as a backdrop and thinking about what you have to do to address the draft guidelines, we thought that would be very powerful and wanted to spend a couple of minutes going through that. So with that, I will turn it over to Sandeep.
Thanks, Rani. Good morning, everyone. So as Rani mentioned, the idea of having a survey up here was to pull out some of the top-of-mind issues for the directors today and try to draw a linkage back to the guidelines, as well as what the senior management should be focused on. This survey covers a broad range of issues, but what we've tried to do is just stay close to the topic at hand and look at risk oversight, risk appetite, board's input to various key decisions within senior management. And this, just as a background, this survey included 860 public listed companies, and 70% of the respondents were on the boards of organizations with $1 billion or over. So it has a healthy mix of small and large organizations and gives a good perspective in terms of some of the key issues that we should be looking at. So the first theme, if you will, we'll talk about is the workload for the directors. And not surprisingly, based on the number of regulations that have come up, the increased focus and sort of the fallout from the financial crisis, we've seen directors spend more and more time. Majority of the directors mentioned that their workload has increased significantly year over year. And it varies by different committee of the board. And compensation committee, which is highlighted here on the top, has seen the most increase. And that is primarily, again, back to the regulations, say on pay and FSB guidelines, and many of those regulations that have started to impact the compensation committee, and internal analysis had to happen, and the recommendations and the alignment to those guidelines. So the workload has increased. And it's consistent with what we also see in the industry. One of the clients we've been working with for past 2 years on different elements of corporate governance, we've had small initiatives to try to enhance various facets of corporate governance for them in the last 2 years. And now in this year, they've had to add one more day to the board meetings, and just to make sure that the increased agenda for the board board members have time to address that and they can deliberate on it. The other implication for senior management from that perspective is also to make sure that the reporting to the board is actionable and it's much more streamlined, so that the key issues are brought to table in a timely fashion and the discussions happen, and sort of the oversight is effective and efficient from that angle. The other key theme which I wanted to touch was around understanding of the risk and the risk appetite for the organization. And I personally think this was the most interesting finding from the survey because almost all, I think 97% of the respondents said that they are moderately comfortable with their board's understanding of the risks that the companies face. And that's a little, not in line with what we've been seeing in terms of the changing regulations, because more and more the regulators are not buying this argument that you understand your risks and you have a full control over the risk oversight. When we started to sort of look deeper into it, we wanted to understand why is that? Why is that the directors feel that they have a full understanding of the risks, but the changing regulations do not agree with that? And I think the answer for that is sort of linked into the third theme, which is some of the improvements that still need to be made in the risk oversight function. So board approves a risk appetite statement, and many of the times we've seen this is a check the box exercise. I have a risk appetite framework, but I don't know how it translates and trickles down into the organization. 37% of the respondents here said that it's not clear to me. I understand my risks in the organization, but it's not clear to me who on the board ultimately has the responsibility to oversee these risks. So the allocation by risk to a specific board level committee is not a consistent paradigm that you see across different organizations. And that is where the structural disconnect happens. So you have a risk appetite framework, but it does not trickle down into the policies, management committees, limits, and does not come back up in form of a monitoring back to the report where you can have a robust oversight for risk within the organization. So it's not to say that the directors do not have full understanding of these issues. In fact, many feel they do, and they definitely do. But it's how do you operationalize that understanding and make sure that's at a framework level, at a policy level, it exists, and also it trickles down into the organization, and everybody across the organization has the same view of risk, and they are highlighting the key issues back to the management. And almost a related final theme is board's involvement in strategy. Now, this was interesting because almost everybody said that board does participate in strategy discussions. So at least annually, there is some forum to discuss strategy with management. We also saw that 1/3 of the directors, or about 40% of them, said, every board meeting we talk about strategy. But there was a dichotomy between smaller organizations and the larger ones. The larger organizations were much more comfortable with the amount of time spent on just talking to strategy, whereas 1/3 of the smaller ones still wanted to have more time, and it's to discuss strategy and understand the implications. But linking back to the previous theme of how do you operationalize this, the opportunity or the issue here is not spending time on strategy, but also how does the board provide input to strategy process? How do you link it back to the risk appetite? And that's where I believe some of the leading practices come in, where it's important to understand that if you have a growth plan for next 2 to 5 years, have you considered the implications on your capital? Have you considered what this will do to your limit structure? Have you done a sort of a scenario analysis of sorts to link your strategy or the risk appetite to your strategy? And that's where the sort of the leaders in the industry differentiate themselves, and they've done a good job of it. So that risk appetite is not just a framework sitting out there, it's actually discussed and used as a framework for decision making. Also, the leading practices also go back to board's role in terms of providing a challenge to the senior management. Is the board's role just to receive a strategy document, deliberate, ask a few questions, or should they be looking at external counsel or hiring somebody to provide an outsider's view and coming up with an option and sort of challenging management in a different direction and having that dialogue with the management? So we definitely saw from the survey that there is a section of leading organizations out there who do engage external counsel, look at external data, and come back with alternates to the proposals from management. And that's where the dialogue happens, and that's where you get much more robust challenge from the board. So keeping all of these themes in mind, and also some of the considerations that Rani mentioned, how do you make this operationalized? How do you take it forward and go to your clients and have a sort of a fulsome approach? So this is the response, or this is sort of the paradigm that we take with us, which considers the entire organization in terms of our engagement. And we would look at top of the house on some of the governance and strategy issues. Some of them I highlighted. But also at top of the house, is there clarity around roles and responsibility? Back to the 3 lines of defense model, do you have clear allocation of risks and link it back to the board level committees and the management level committees? Do the policies align? Do the procedures align? So those would be some of the elements we would consider at sort of the top of house, understanding the framework within the organization to ensure a robust risk oversight. And sort of in the middle, we will have various elements for an oversight function. And this is just an illustration for risk management, but this could be compliance or some of the other functions where we look at the entire spectrum of activities, right from business planning to business evaluation, and how does that oversight function sort of execute its mandate and ensure a robust oversight is in place. The processes are effective, the internal controls are valid, and they support the direction that is set by the board and senior management. And we look at this spectrum across all the product types, all the risk types, different geographies, different business divisions. And finally, our elements or our focus area will also consider the enablers or the analytics and infrastructure in place. The people involved, the qualification that they have, the tools and technology. Does it line up and support effectively the processes you have in place? So this is just a high-level approach, and we just wanted you to have an appreciation of kinds of things we look at. But to make it a bit more real, we'll discuss a case study and get into a little bit more specifics. So I'll ask Rani to take that over.
Sandeep. So as I said earlier, a request that I get very often from my clients is, okay, so there's this draft corporate governance guideline that's been issued. Help me understand, Rani, what would be involved. What are some of the things that you might look at as part of the review? I just want to get a sense of the scope of the review. So this is a discussion that I've had quite a few times with my clients and continue to do. So we wanted to give you some insights into the sample elements that we would review as part of a corporate governance review. And so it really falls into 3 different buckets. We look at the board's role, we look at risk governance, and we look at management's role. So I'll start with the board's role. In terms of the board's role, we'll look at composition of the board. We'll look at how the board is carrying out its oversight responsibilities. We'll also look at the interaction with management. We're very interested around, how are issues raised? How does the board challenge information that they're receiving from senior management? We'll look at how they'll monitor against, the organization's strategy and the risk appetite. And we'll also take a look at the self-assessment process. Okay. In terms of risk governance, here we focus on risk appetite and reporting. So we'll want to take a look at how the board is involved in setting and approving the risk appetite for the organization. And we see this is an evolving space, quite honestly, and we see that in some organizations the board is asking a lot of questions around the risk appetite in terms of the development of the risk appetite, because they too are trying to understand how it all comes together. And in some institutions where it's a bit more mature, they're spending less time kind of developing it, but more time in understanding and approving. And then we look at reporting. And here we're interested in, to what degree are reporting requirements being driven by the board versus senior management? So is the board asking for information and telling senior management what they want to see? Is it a combination of the two? How does information flow upwards and downwards? So we spend a bit of time focusing on that. And then management's role, again, we're very interested in speaking with senior management about their interaction with the board. Again, we want to understand, the type of dialogue that takes place, how often it takes place, the type of issues that are raised, when they're raised. Really just want to try to get a sense from senior management, the type of interaction that they have. Risk culture, here we focus on, is there a culture of no surprises within the organization? And where does that come from? Is that a tone that's set by the board? Or is that, just just the way the organization functions and has always, and it's just part of their infrastructure, if you will. And then the clarity and appropriateness of some of the roles and responsibilities along the 3 lines of defense. So we'll look at, business, we'll look at the independent control functions, and we'll look at internal audit as the 3rd line of defense. Okay. I didn't want to go through all of the assessment criteria in detail, but we have it here for you to read at your leisure. On this slide, what we did was, again, wanted to give you a sense of what would be included in a review of an oversight function. And in most cases, for compliance and for risk management, all of these areas would be looked at. So we would look at the mandate and the scope for that function. We look at stature of that function and independence within the organization. So we would, want to make sure that, for example, internal audit has the appropriate stature within the organization, has some teeth. The challenge role that independent control function is playing, particularly in the risk management space. In terms of organizational structure, here we'd want to look at how issues are being escalated to the board. alignment of risk to management committees and things like that. So those are areas that we would focus on as well. In terms of resources, what we look at here are the mix and skills of the resources and kind of the quality of the individuals within the organization and the sufficiency as well of the resources within that function to ensure that there's appropriate coverage. We'll look at training, we'll look at performance management, just to ensure that individuals are getting the training that they need if there are evolving areas. And in terms of infrastructure, we focus on policies, procedures, and guidelines. We'll look at reporting, emerging risks, and things like that. Okay? So again, didn't want to spend a lot of time, but wanted to give you a sense of what would be included in a review of an oversight function. What we've done here is we have set out for you just a picture around, one to leave with you a sense of who would we speak to as part of these reviews. Right? So obviously we will speak with, when you're carrying out a review, for example, of one of the oversight functions, we will speak with some people on the board, some of the board members, maybe not all. Even in a corporate governance review, Sandeep and I worked on one client where when we were doing the corporate governance review, we did not speak to all the board members. We only spoke to the chairs of the committees. And that was because they felt that we would get an appropriate view and perspectives by speaking to those individuals alone. But in some instances, there's another client that we worked on where we spoke to all the board members because they all had different things to offer. And so you really just have to make a judgment as to, do you want to speak to everybody or is it just the risk committee? And sometimes, we may have a view and our client may have a view, and collectively we'll come to an agreement as to who at the board level should be included in the interview process. We will also speak to the heads of the business functions as well. Again, really important to get their insights around, their interaction with the board, what they're reporting, how they're escalating issues and things like that. So we would certainly want to do that. For insurance companies, we speak to the chief actuary. We'll also speak to the heads of all of the oversight functions. We want to get a sense of what type of reporting are they giving to the board at the committee level or the full board level. Again, the interaction, issue escalation, challenge is really important. I think here support and independence is also really important, so we'll speak to them. And then just on the right-hand side over there, we've just kind of set out all the folks that we would want to speak to as part of these reviews. So again, this was really just to try to answer that question around what would be involved, who would you want to speak to, how does this all kind of come together? Okay. Sample questions. I'm not going to go through each of these in detail, but wanted to share with you the types of questions that we would ask as part of these reviews. So, for board of directors on issue escalation, you'll see here, describe the types of issues that are escalated to the board. We want to get a sense of what does the board see and how does that kind of come together. Board reporting, I mentioned this one before. We'll ask questions around the types of reports that are given to the board. We'll actually review minutes of board meetings. And again, want to get a sense of to what degree are reports provided to the board, and the board kind of come back and say, well, you know what, can you take it in a different direction? I'd like to see a little bit more here and a little bit less here. So, we'll probe a little bit in that area. We'll ask some questions around succession planning for the board as well. Senior management, we focus on strategy and risk appetite. Here we really want to get a sense of the board's involvement in strategy setting and risk appetite setting. And further, how is that strategy kind of being monitored, and the risk appetite, how is it monitored throughout the year? And so we want to get a sense of the process that the board goes through to carry out those responsibilities. We'll ask some questions around the performance evaluation process, because that's a really important aspect, related to all of this. And again, assessment of the interaction between the board and senior management. Here, we want to just get a sense of, how robust is it? Does senior management feel comfortable raising issues to the board? And when does that usually happen? And how does that really happen? So those are some of the questions that we would ask in areas that we would probe. And again, I think the same on the oversight functions. We'll leave you with these questions. I won't go through them in detail, but I think you're getting a sense of the types of things that we might ask. Okay. So I thought we would leave you with examples of some leading practices that we're seeing. We've done quite a few of these reviews over the last little while and just wanted to share some insights with you. As Sandeep had mentioned earlier, some leading institutions, the board is very much involved in setting and monitoring the strategy for the organization as well as the risk appetite. So really, we're seeing a lot of involvement, a lot of really good understanding around the risk appetite for some institutions. Directors kind of spending time ensuring alignment between the strategy and the risk appetite. So there's some institutions where we see that they're doing that very, very well. A dedicated board-level committee established to oversee risk management. So that's certainly a leading practice that we see out there. Heads of control functions having adequate stature and independence. This is a really important one, I think. The board really relies on the heads of the heads of oversight functions to help carry out their oversight responsibilities. So I think it's really important that these oversight responsibilities, the heads of these oversight responsibilities or oversight functions, have appropriate stature within the organization. So are they respected? Are issues that they raise actioned? Those are some of the things that we would focus on. Obviously, want to ensure that the board has a good mix of individuals with different skills and backgrounds. Again, the clear allocation of specific responsibilities exists for overseeing major risks. That's certainly a leading practice as well. So I hope that this was helpful and it gave you some insights into what we're seeing in the industry and how some of these reviews might come together. That's the end of our formal presentation, but we'd be happy to open it up to any questions. We've got about 15 minutes. Yeah.
In your surveys, how do you see the role of a board in a public company versus a fully owned sub and the board involvement in compensation strategies and business strategies?
Don't know if our... Sure. So the question was, how would we, and please jump in if I don't get your question correctly, but how do we see the difference in a public versus a private company? A public company versus an owned subsidiary in terms of the board's role in compensation? Is that what you said? Compensation and strategy. I don't know if the survey actually addressed that.
Well, survey captured that in a different way. Although there's no, so the question asked to the directors on the subsidiaries as well as other public companies, the roles and responsibilities are really the same. For private companies, that's a little unclear, and I don't think the survey sort of went to that depth in asking those questions. But the roles and responsibilities around compensation, performance management link back to do you have performance linked to risk related considerations? Is it linked to, obviously performance is linked to strategy and growth, but do you tie it back to other risk-related risk appetite framework and such? So those are some of the nuances that are built into the roles and responsibilities around that.
What are your views of having a committee comprising both directors and management? Saying having the chairman of the board chair the committee, chairman of the audit committee on that risk committee, and then having, say, the chief legal officer, chief financial officer, chief technical officer also on that committee. That will provide unfiltered information reaching the board.
I'm sorry, were you asking what are our views?
What are your views on having a hybrid committee comprising both management and directors?
Well, from what we've seen in the industry, and what we also believe is sort of the appropriate practice to have, is board should have their own, directors should have independent thought and consideration, but the flow of information, you're right, that has to be built in. So the way is not to get around making a hybrid committee, but rather having free access to the key control people. So heads of oversight functions. So for risk management, for example, you'll still have all directors in that committee, but it'll have free access for the CRO to come and talk to the board or the committee at any time. They'll have pre-meetings where CRO would discuss key issues with the chair of that committee. So there are other avenues where you can address the free flow of information, but I think the independence and that sort of angle, we haven't seen a hybrid formula floated around out there.
Yes.
So I was interested in your comments about the difference in OSFI's view and the board's view on comfort with risk appetite, and why you thought the difference was. I'm wondering, and I'd like your view on.
I think a lot of board of directors are comfortable with risk appetite because they understand it qualitatively as a corollary of strategy. Right. It's not evident in the Corporate Governance Guideline, but it appears if you peel that back. Do you think that OSFI is looking for more quantitative risk appetite statements as opposed to qualitative, and that could be why there's a difference between how boards are looking at themselves? And also, in your practice, are you seeing financial institutions using quantitative or qualitative expressions of their risk appetite? Two-part.
I could take part
Sure.
of that, and you can take the other part. I think, I'm not, I can't get into the head of OSFI in terms of why they don't feel comfortable with, what boards are doing as it relates to the risk appetites. It's just a different opinion, right? So boards feel that, yes, they're well involved in managing the risks. They understand the risks of the organization. I think for some of the larger institutions, that's probably true. And it could be that some of the changes that are proposed in the draft guideline are for some of the smaller institutions, right? And are we seeing quantitative measures in risk appetite frameworks?
Well, it's a mixed bag. So the leading practice definitely is to go towards having more quantitative measures. Qualitative have been there, reputational risk and some of the other things. But it goes back to how do you link it to your limits, right? So risk appetite at the top of the house has to trickle down into everything you do. And that's where the quantitative piece comes in. So that's one way to do it. There's no, I won't be able to give you here are the 5 things you implement, and your risk appetite is a fully functional document then. It really is a very difficult exercise and has to be sort of a pyramid view of the business lines rolling up. And really, more you dig deeper into it and have statements that reflect the reality of the business, I think that's where the regulators are getting to, and it's a harder problem than just putting a statement up there.
Like, for example, in operational risk, we're certainly seeing a move with some of the larger institutions developing a risk appetite statement for operational risk, which is a combination of quantitative and qualitative statements. It's not easy to do. It's not easy to understand. But we're certainly seeing, an expectation that you move down that way. Any other questions?
First of all, thank you for the presentation. I just wanted to ask you in terms of timing, when do you expect the final version of corporate governance to come out? And how much do you expect it to differ from this draft that was issued in August? Thank you.
It's my own personal view. This is not based on anything that I've heard, released officially. But given how short the comment period was between the draft guideline and closing it for comment, I think it was like a 6-week window. I don't anticipate, just based on that, I don't think there'll be a lot of changes in the final guideline. But I could be completely wrong. And I do think that it's going to come out pretty soon. I would think within the next little while, I do think it will be released. But don't quote me. Anything else? Okay.
Sandeep, thank you very much for the presentation, and thank you to all of you for attending this morning. As you know, we try and run an eye-opener presentation every quarter, so our next one will be in early spring. You'll obviously be on our invitation list for that. If you don't mind, on your tables with the presentation, you will have found a comment card or a feedback card. We really would appreciate you spending a minute to just fill that out. It helps us keep us on our toes and make sure that we appropriately bring the right topics to bear. So thank you very much. Certainly some of us will be around if you wanted to talk just before you leave, and I think we've got you out just on time. Thank you.